All right, let's talk about something that can totally change your trading game. We're going to dive into a much smarter way to protect your capital and your profits, volatility stops. It's all about learning to listen to what the market is actually telling you instead of just, guessing. Okay, let's jump right in. Oh man, we've all been there, right? You do all your homework, you pick the right direction, the trade starts moving your way, and then bam, some minor, totally meaningless dip stops you out, and you have to sit there and watch the market just take off without you. It's got to be one of the most frustrating feelings in trading. And that exact frustration, it really points to a core problem, something we'll call the trader's dilemma. And it highlights a really fundamental and often very costly imbalance in how a lot of us approach our trading plan. And this slide just nails it. So many traders will pour hours, sometimes even days, into finding that absolutely perfect entry signal. But the exit, well, that's usually just an afterthought, some random number they pull out of thin air. And that neglect, that's exactly where so many potential profits just vanish. This quote from our source material really hits home, doesn't it? Being right about the direction is just step one. If your exit strategy can't handle the market's natural rhythm, its normal ups and downs, you're going to constantly miss out on those really big account-changing wins. And here's the real kicker. A fixed number, like a $500 stop loss, is completely disconnected from what the market is actually doing. It just totally ignores the very volatility that probably made you want to get into the trade in the first place. That's why these arbitrary stops fail so often. They just aren't adapted to the personality of the market itself. Okay, so what's the alternative? Well, instead of forcing our own rigid, arbitrary rules onto the market, we need to learn to start listening to its noise. Let's break down what that actually means. So noise isn't just chaos. Think of it more like the unique signature of a market. Every single market has its own normal, measurable level of volatility. Those little wiggles and pullbacks that happen against the main trend. The key is to stop seeing this as a threat and start seeing it as a characteristic we can actually measure and work with. And this is the fundamental shift in thinking. This is the big aha moment. Instead of putting your stop right where it's going to get hit by all this normal noise, you place it just outside that range. You give your trade room to breathe. And there's a huge psychological win here too. This data-driven approach takes emotion out of the equation. No more fear or greed, just a logical plan. So how do we measure this noise objectively? Well, one of the most powerful tools traders use is the average true range, or ATR. Let's break down how you can use it to set a way smarter stop loss. To put it simply, the ATR just measures a market's average daily price movement over a specific time, like maybe 14 or 20 days. It gives you a real, concrete number for that market's noise level. So, for example, if a stock has an ATR of 10 points, it means it moves about 10 points on an average day. It's a direct, objective measure of its volatility. And here's how you actually put it to work. The good news is most charting software will calculate the ATR for you, so you don't have to be a math whiz. The key step is choosing a multiplier, often 2 or 3, to set your stop just outside that typical daily noise. This creates a logical, data-driven buffer zone for your trade. The entire idea here is to just accept that markets are going to have some noise against the main trend. By basing your stop on a multiple of that noise, you dramatically increase the chances that your trade will survive those minor pullbacks and stay in for the major move you were hoping for. Now, theory is all well and good, but let's see how this stuff actually plays out in a real-world scenario. We're going to compare the ATR stop with a few other types of volatility stops, just to see the different ways they perform. So for our case study, we're pulling from our source material. It's a short trade in the soybean market, and we're going to see how 4 different trailing stop methods would have handled this specific downtrend. This table lays out the options so clearly. And you'll notice a key theme right away. Every single one of these methods involves a trade-off. There's no free lunch. Take the highest high stop. It's awesome for staying in a really long trend, but you're going to give back more of your open profit at the end. The ATR stop, on the other hand, is better at protecting your gains, but it might get you out of a trade a bit sooner. It really shows there's no single best stop. It all depends on your goals. So, you can almost think of these stops as having different personalities. Which one sounds more like you? The highest high is kind of like the patient, long-term investor. The ATR is the cautious one, always protecting profits. The swing chart follower just goes with the flow of the market structure. And the Gann angle? That's the precise engineer. The real question is, which approach fits your trading style? Okay, now this is a really, really crucial warning. Volatility stops are specifically designed for markets that are trending. If a market is just chopping sideways with no clear direction, these stops are probably going to get hit over and over, leading to a string of small losses. They are tools for following a trend, not for navigating a sideways mess. So, with all of this information, how do you actually go about choosing the right exit strategy for you? Well, it really all boils down to one fundamental trade-off. Ultimately, your decision comes down to two philosophies. If you set a fixed profit target, you guarantee you won't give back any of your open profit, but you absolutely put a ceiling on your potential upside. On the flip side, if you use a trailing stop, like the ones we've been talking about, you risk giving back some profit, but you open yourself up to the possibility of capturing a truly massive trade-defining trend. So let's bring it all home. The number one thing, don't neglect your exit. Always base your stop on the market's real volatility, not just some random number. The ATR is an amazing tool for this. And just remember, every single strategy has its pros and cons. The right choice is always going to be the one that aligns with your personal trading goals. And I'll just leave you with this final thought to really consider. Take a hard, honest look at your own trading. Is your current approach to exits truly helping you maximize your potential, or is it unknowingly cutting your best trades short?